So now let's talk about the issuance of stock. So when we're issuing a stock, a separate account has to be used for recording the amount of each class of stock. So let's see an example. Assume that a corporation is authorized to issue 10,000 shares of $100 preferred stock and 100,000 shares of $20 par common stock. The corporation issued 5,000 shares of preferred and 50,000 shares of common stock. So you can see that they didn't they didn't issue everything that was authorized. They actually went only 50%. The corporation entry to record the stock of issuance would be as follows. So one thing I also want to pay your attention to is that the par value is the amount that's going to be used for the issuance of these common stock, because the common stock were issued at par. So let's see how this works. So we're going to credit preferred stock, and how we do this is basically we take the number of shares issued, 5,000, multiplied by the par value, which is $100, and that would be 500,000. And then we take for the common stock, we're going to credit that, and remember, preferred stock and common stock, these are equity accounts, and that's why they're on the credit side. So we take the 50,000, multiplied by $20, and that's going to be $1 million. So $1,500,000, these were issued in the market. We received cash, so we're going to debit cash for the total, which is $1.5 million. So stock is often issued by a corporation at a price other than its par. The price at which stock is sold depends on a variety of factors, such as the financial condition, earning records, and dividends record of the corporation. Could be also investor expectation of the corporation's potential earning power, or in other words, investor expectation for the growth of the corporation, and also general business and economic condition and expectations. If the stock is issued or sold for a price that is more or higher than its par value, then the stock has been sold at a premium. If the stock is issued for a price that is less than its par value, then the stock has been sold at a discount. So we'll see some examples of how premium and discount can affect the issuance of stock. And let's start with the premium case. So when the stock is issued at a premium, cash is debited for the amounts received, which is basically going to be higher than the par value of the common stock issued, or preferred stock. So common stock or preferred stock is credited for the par amount, and then an account entitled paid in capital in excess of par is credited for the excess of the amount paid over par. So let's see an example. Assume that Caldwell Company issues 2,000 shares of $50 par preferred stock for cash at $55. The entry to record this transaction would be as follows. They're going to credit preferred stock based on the par value, which is the $50, so 50 multiplied by 2,000, and that's going to be 100,000. And since it was sold for a price higher than its par, and you can see that there's a $5 more, so this $5 extra are going to be treated as paid in capital in excess of par for preferred stock. So we take the extra $5 multiplied by 2,000, and that's going to be $10,000. I just want to let you know that $10,000 is still part of the contributed capital. It's not something different. It's just an additional amount paid on top of the par value of the preferred stock. So we credited the preferred stock and its related paid in capital in excess of par preferred stock account, and then the total is 110. We're going to debit cash for the same value, which is the $110,000. When stock is issued in exchange for assets other than cash, such as land, buildings, and equipment, the assets acquired are recorded at their fair market value. So if this value cannot be determined, the fair market value of the stock issued is going to be used. So let's see another example. Assume that a corporation acquired land with a fair market value that cannot be determined. In exchange, the corporation issued 10,000 shares of its $10 par common stock. If the stock has a market price of $12 per share, the transaction would be recorded as follows. So please notice that the investor in this case gave us land, and we gave them 10,000 shares instead. We cannot determine the price of the land or the value of the land. So what we've done is that we are going to see the value of the shares that we are given back to the investor in exchange for the land. So in this case, even though the par value is $10, the market price of these shares is $12. So we have to multiply the par value, the market price of the stock by the number of shares that has been given in exchange of the land. So we're going to credit common stock, but we're going to use still the par value, which is 10 multiplied by 10,000, so it's $100,000. And then the paid in capital would be the extra $2. $2 multiplied by 10,000, and that would be $20,000. We add them together, and that would be the value of the land, $120,000. So we debit land for $120,000. And please notice that we didn't use cash in this example. So the exchange was between land and stock. The next example, we're going to see no par stock. So when no par stock is issued, cash is debited and common stock is credited for the proceeds. We're not going to use this account called additional paid in capital in excess of par. So as no par stock is issued over time, this entry is the same even if the issuing price varies. So let's see this example. Assume that on January 9th, a corporation issues 10,000 shares of no par common stock at $40 a share. On June 27th, the corporation issues an additional 1,000 shares at $36. The entries to record these issuance of the no par stock would be very simple because we're not going to think too much. We're going to record the common stock based on the selling price and record the cash based on the selling price, which is very simple. So for the January 9th transaction, we take the 10,000 shares multiplied by $40, and that's $400,000. So we debit cash for $400,000, credit common stock for $400,000. For the June 27th transaction, the price went down 36, so we still issue the common stock. So 1,000 multiplied by 36, that's 36,000 on the credit side, and cash is going to be 36, which is the exact same value. So in some states, no par stock may be assigned a stated value per share. So the company would just state a value, but it's not really a par value, so it's not documented on the stock. So the stated value is recorded like a par value. Any excess of the proceed over the stated value is credited to an account, very similar in name, called paid in capital in excess of stated value, instead of saying in excess of par. So let's see this example. So assume that on January 9th, the corporation issues 10,000 shares of no par common stock at 40. And then on June 27th, the corporation issues an additional 1,000 shares at 36. The no par common stock is assigned a stated value of $25. So we basically record this transaction as if there was a par value. But instead of using the term par value, we're going to use the term stated value. So I'll start with the common stock using the stated value. So it's $25 multiplied by the 10,000 shares, and that's $250,000. And we know that it was sold for 40, so we have $15 extra, which is the difference between 25 and 40. So $15 multiplied by the 10,000 shares, that's 150. We add them together, and that's going to be the amount of cash we received. For the next transaction, we record common stock again based on the $25, but it's only 1,000 shares, so 25 multiplied by 1,000, that's 25,000. And then we sold it for 36, so we have $11 difference. So that's the paid in capital in excess of the stated value. 11 multiplied by 1,000, that's 11,000. We add these 25 and 11, and then the total is 36. So that's basically, you can see that in the no par stock, if we have a stated value, it's going to be basically the same as a par value. So let me stop here. In the next video, we're going to be talking about dividends.